Ever pondered over the terms puts and calls in options trading? Well, today we're going to unravel this financial jargon and make it as simple as a piece of cake. Options trading, my friends, is a type of derivative investment. Now you might be wondering, what on earth is a derivative investment? It's just a fancy term for a contract that derives its value from the performance of an underlying entity. So, in the realm of options trading, we deal with two main types of options: puts and calls. Imagine them as two sides of the same coin, each with its unique features and benefits. A call grants the buyer the right, but not the obligation, to buy an asset at a predetermined price, while a put gives the buyer the right to sell an asset at a preset price. Intriguing, isn't it? So, are you ready to dive into the world of puts and calls? Firstly, let's understand call options. Call options are a type of financial derivative, a contract between two parties that gives the holder the right to purchase an asset but not the obligation. This asset could be a stock, a commodity, or even a cryptocurrency. The asset's price is predetermined and is referred to as the strike price. Now, imagine you're at an auction. You see a beautiful painting and you think it's undervalued. You believe that in a month or two, its price will increase. But right now, you don't have the money to buy it, so you make a deal with the auctioneer. You pay a small fee, and in return, you get the right to buy the painting at the current price within the next 2 months. That's essentially how a call option works. The fee you pay is called the premium, and it's the price you pay for the right to buy the asset later. The auctioneer, on the other hand, is obligated to sell you the painting at the agreed price if you choose to exercise your right. The beauty of call options is that they allow you to control a large amount of an asset with a relatively small amount of money. They offer potential for significant profits if the price of the underlying asset increases beyond the strike price plus the premium. However, if the price of the asset doesn't rise as you had hoped, your maximum loss is limited to the premium you paid. You can simply choose not to exercise your right to buy the asset, and the contract expires worthless. It's important to note that while call options can be an effective way to leverage your investment, they also come with a fair amount of risk. They're not for everyone, and they require a good understanding of the market and the asset you're dealing with. Call options, in essence, are contracts that bet on the price of an asset going up. You might wonder how these call options work. So, let's simplify it with a little analogy. Imagine you're in the market for a new car. You find the perfect model, but you don't have the cash to buy it right now. The dealer, however, offers you an option. You pay a small fee, and in return, the dealer agrees to keep the car for you at the current price for a certain period. That's essentially how a call option works. In the world of trading, the car is the underlying asset, be it a stock, a commodity, or a currency. The dealer is the seller of the call option, and you, my friend, are the buyer. The fee you pay is called the premium. The current price of the car, or in our case, the asset, is what we call the strike price. And the agreed upon period, that's the expiration date. Now, here's where it gets interesting. If the price of the car or the asset goes up before the expiration date, you can buy it at the lower strike price and sell it at the current higher price, making a profit. But if the price goes down, you can simply choose not to buy the car or exercise the option. The most you lose is the premium you paid. But remember, it's not all rainbows and butterflies. The premium isn't refundable. And if the price of the asset doesn't go above the strike price before the expiration date, you lose the premium. And trust me, those premiums can add up. Also, keep in mind that just like you don't own the car until you buy it, buying a call option doesn't mean you own the asset. You have the right but not the obligation to purchase it. You're essentially betting on the asset's price to increase. Keep in mind that buying a call option doesn't mean you own the asset, but you have the right to purchase it. And that, dear friends, is the crux of how call options work. Now, let's switch gears and talk about put options. Just like the call options we discussed earlier, put options are also financial contracts between two parties. But unlike call options, which give the holder the right to buy an asset, a put option gives the holder the right, but not the obligation, to sell an asset at a specific price, also known as the strike price, within a specific period of time. Think of it this way. You're holding a ticket to a concert, but for some reason you can't attend. What do? You sell your ticket, right? A put option is like that ticket. It allows you to sell an asset you own, like a stock, at a price you're comfortable with before a certain date. But why would you want to do that? Well, imagine you own a stock that you think is going to decrease in value. By purchasing a put option, you can lock in a selling price for that stock. If the stock's price does drop, you have the right to sell it at the higher agreed upon price. This helps to limit your potential losses. But remember, just like with call options, you're not obligated to sell. If the stock's price increases, you can simply let the option expire and keep your stock. Also, just like call options, put options involve a premium. This is the price you pay for the right to sell the asset. The premium is determined by several factors, including the strike price, the expiration date, and the volatility of the underlying asset. So, to sum it up, put options offer a way to hedge against potential losses on assets you own. They allow you to lock in a selling price for an asset, providing a form of insurance against a drop in the asset's value. Put options, in essence, are contracts that bet on the price of an asset going down. Now, how do these put options function? Let's dive right into it. Imagine you're a collector of rare comic books. You've got a gem in your collection, a first edition of a popular series, and you've heard rumors that its value might drop in the near future. You're worried and want to protect your investment, right? This is where put options come into play. A put option is like an insurance policy for your comic book. You pay a premium for the right to sell your comic book at a specific price known as the strike price within a certain period. This period ends on the expiration date. If the market price of the comic book falls below the strike price, you can still sell it at the strike price, thereby limiting your loss. Isn't that neat? Let's say you bought the put option with a strike price of $200 and the market value of the comic book drops to $150. You can still sell it for $200, even though its market value is less. The difference of $50 is your gain, minus the premium you paid for the put option. But what if the market price stays the same or even increases? Well, the most you stand to lose is the premium you paid for the put option. You can simply let the option expire and keep your comic book. So, a put option gives you the right, but not the obligation, to sell an asset at a predetermined price within a specific time frame. It's a strategic tool to hedge against potential losses in a volatile market. And here's the kicker. You don't actually need to own the comic book to buy a put option. Some traders buy put options speculating that the price of an asset will drop. They can then sell the option for a profit before it expires if the price does indeed fall. Remember, buying a put option doesn't mean you must sell the asset, but you have the right to do so. Now that we've learned about both puts and calls, let's summarize the key points. To begin, let's recall that both puts and calls are types of options. They are contracts that provide the buyer with the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, known as the strike price, within a specified time frame. This is the fundamental principle of options trading. Call options, if you remember, give the buyer the right to buy an underlying asset. You'd buy a call option if you anticipate that the price of the underlying asset will increase in the future. It's like reserving a commodity at today's price, expecting that it will cost more tomorrow. If your prediction is correct and the asset's price does rise above the strike price, you can exercise your call option and buy the asset at the lower, predetermined price. On the flip side, put options give the buyer the right to sell an underlying asset. You'd buy a put option if you expect that the asset's price will decrease in the future. It's like securing a selling price for a commodity today, predicting that its value will drop tomorrow. If you're right, and the asset's price falls below the strike price, you can exercise your put option and sell the asset at the higher, predetermined price. So, with both puts and calls, you're making predictions about the market and using these tools to potentially profit from your forecasts. But remember, with great potential comes great risk. If your predictions are incorrect, you could lose the premium you paid for the option. Another crucial point to remember is that options provide rights, not obligations. Just because you have the right to buy or sell an asset doesn't mean you're required to do so. If the market doesn't move in your favor, you can let the option expire worthless. Your loss, in this case, is limited to the premium you paid to buy the option. It's also important to note that options trading isn't just about making predictions. It's also a strategic way to hedge against potential losses in other investments. For example, if you own a stock and fear its price might fall, you could buy a put option. If the stock price does drop, the gain on your put option could offset the loss on your stock. In conclusion, puts and calls are two sides of the options trading coin. While they operate differently, they both provide the right to buy or sell an asset, allow traders to capitalize on their market predictions, and offer a way to hedge against risk. Remember, though, that while they can be profitable, options also carry significant risk. Always do your homework and consider your financial situation before diving into options trading. Puts and calls, while different, are both essential tools in the options trading world. So, we've sailed through the world of puts and calls today. We've journeyed through the fundamentals of options trading and specifically delved into the concepts of call and put options. We've learned that options trading is a strategic method used by investors worldwide, offering flexibility and the potential to profit in virtually any market conditions. We've discovered that call options are contracts that give us the right but not the obligation to buy an asset at a specified price before a certain date. They allow us to control a large amount of stock for a relatively small cost and can provide substantial returns if the price of the underlying stock rises. On the other hand, we've explored that put options are contracts that give us the right, but not the obligation, to sell an asset at a specified price before a certain date. They allow us to profit from a decline in the price of the underlying asset and can act as an insurance policy for our stock portfolio against a market downturn. We've also covered how these put and call options work. We've seen that the profitability of call options increases as the price of the underlying stock rises, while the profitability of put options increases as the price of the underlying stock falls. We've understood that the key to successful options trading lies in predicting the direction of future price movements accurately. But it's important to remember that while options trading can offer significant rewards, it also carries substantial risks. The potential for losses is just as great as the potential for gains. This is where the importance of understanding puts and calls in options trading comes into play. Knowledge of puts and calls can help us make informed decisions about when to buy or sell options and what type of options to trade. It can also help us manage our risk effectively by allowing us to create strategies that can profit in different market conditions and limit our potential losses. But remember, this is just the tip of the iceberg when it comes to investing and trading. There's a whole ocean of knowledge out there waiting to be explored. So don't stop here. Continue to learn, continue to grow, seek out more information, ask questions, and never stop investing in your financial education. In the world of investing and trading, knowledge truly is power. It's the key to making informed decisions, managing your risk, and ultimately achieving your financial goals. So keep learning, keep growing, and keep pushing towards those goals. Remember, knowledge is power, especially when it comes to investing and trading. Thanks for joining us today, and we look forward to seeing you next time.